Today we're breaking down a powerful interview with Dan Ives, Global Head of Tech Research at Wedbush Securities, where he explains why the market is getting AI and cybersecurity completely wrong. This comes from his appearance on CNBC, where he pushes back on the recent downturn in cybersecurity stocks and makes it clear that AI is not a threat to the sector, but the biggest opportunity ahead. I'm going to play the clip of Dan Ives first, then I'll give you my own detailed reaction and breakdown of what he's really saying beneath the headlines. After that, I'll walk you through my in-depth analysis of the top 3 hyper-growth tech stocks to buy based on this theme. If you find value in this video, make sure to hit the like button, share it, and drop your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now let's hear what Dan Ives has to say.
It's good to see you.
Great to see you.
So why has cyber been swept up in everything that's been going on?
Yeah, I think part of it is just this software, right? I mean, the view is that can cyber be disintermediated by some of these tools, whether it's Anthropic or some of the, really the startup tools that are coming from an AI perspective. Mm-hmm. To my point is, look, coming into this year, all of our checks are showing cybersecurity should actually see anywhere between 300 and 500 BIP acceleration. I think some of that is because as you see the AI use cases deployed, you look at Palo Alto, they don't acquire CyberArk if it's not for AI. Mm-hmm. CrowdStrike, all the stuff George and the team are doing. I think this is one, I get it's a guilty till proven innocent, but cybersecurity, this is going to be, I think, it's a moment that inflects, and ultimately it's going to be a huge growth area for the sector that I don't think is being factored in here. Right now it's being viewed as a headwind, but tonight it's very important to hear from Nikesh. He has a great perch.
I mean, part of me wants to say, well, how can you have checks on things that we don't really know what we're checking for yet?
Sure.
Like, we don't know what these other tools are going to do and how they're going to disintermediate certain industries until we actually see it.
Yeah, I think to even get more granular, typically going into an IT budget cycle, let's say about 5 to 8% of maybe that budget is what I would call cybersecurity related. Now what's happening, because so many more of these comprehensive solutions, AI platforms end to end, I'd say about 70% of IT budgets have an AI sort of angle. Cybersecurity is now not 5 to 8%. You could argue from everything we're seeing, 20-25% of now the potential budgets that they could go after. So when I look at Palo Alto, CrowdStrike, Zscaler, like Scott, I think this is one I know we've talked about a lot in software, but cybersecurity I think is being mispriced that AI is a headwind, where in fact I think it actually is going to change the view of the sector for years to come, as well as also I think it's going to be a huge catalyst for M&A.
I mean, you've looked at Palo Alto specifically, I think, on this very program and declared it, in your words,
table pounder,
right?
Yeah.
I mean, you still believe that, or is in some respects the jury still out even for you? You want to see what they deliver tonight, because the stock's had some upset in the past around earnings. It's not like this thing just goes straight up.
Yeah, no, look, there's 3 reasons why this is, I view it as double table pounder, because the CyberArk deal will be viewed as the deal that changes Palo Alto. I think what Nikesh did there, you're talking about $25 billion that I could argue is going to generate hundreds of billions in the future of market cap, ascension, given what that gives them a full end-to-end platform. 2, if you look where they play, just like CrowdStrike, we are now getting to an inflection point where you are going to start to see AI. I think 25% of the deal flow ultimately will be positively influenced. That's not factored into the street numbers. Sentiment's super negative, and that's why, to me, Palo Alto, CrowdStrike, those are the ones that I view as just names that, not even just in cybersecurity, but overall tech, are 2 of the top.
I mean, I mean this respectfully. I truly do. I feel like you're a defend first, ask questions second kind of an analyst, right? Yeah. The companies have an upset, very quick to come out and defend the name, defend the price, defend your call, et cetera. You afraid you're missing something on any of this stuff?
And look, it's valid, Scott. What I would say is that, but that's all the work that we do in talking to the hundreds of resellers, partners, all the checks, all the travel. It's the one that gives me the confidence to where if there's a quarter that we miss, or there's some nuance where the stock's down, the reason I defend is because all the work that goes into it, and I know that I feel like based on our thesis and what I've done 25 years, I could defend it despite maybe sort of a speed bump or tripping over the shoelace. That's why I think sometimes especially on some of these names, you have to be able to see forest for trees. That's all the work we do.
So we start with the overall tone of the interview, and that tone is defensive but also very confident. Dan Ives from Wedbush is clearly pushing back against the negative sentiment that has been hanging over software stocks, and especially cybersecurity. The host opens by basically asking why cyber stocks have been dragged down along with everything else in tech. Dan's answer right away centers on fear. Specifically fear that AI tools could somehow replace or disintermediate traditional cybersecurity companies. He brings up AI platforms and startups, even mentioning names like Anthropic, to illustrate the concern that newer AI-driven tools could reduce the need for legacy cyber solutions. But his core argument is that this fear is backwards. In his view, AI is not weakening cybersecurity demand, it is accelerating it. And personally, this is one of the points where I actually agree with him. Every major technological shift we have seen creates more attack surfaces, not fewer. AI adds complexity, automation, and scale, which are basically a hacker's dream if defenses are not upgraded alongside it. Dan then leans heavily on his channel checks. He keeps referencing his research, conversations with partners, resellers, and enterprise customers. According to him, heading into this year, cybersecurity spending is set to accelerate by several hundred basis points. That is his way of saying growth is speeding up, not slowing down. He argues this is directly tied to AI use cases being deployed across enterprises. Companies are not experimenting anymore. They are rolling AI into real systems, real workflows, and real data environments. He points to companies like Palo Alto Networks and makes the case that their strategy only makes sense in an AI-driven world. The mention of Palo Alto acquiring CyberArk is important here because Dan frames that deal as something that would not have happened without AI changing the landscape. The same goes for CrowdStrike and the broader platform approach they are taking. One thing I found interesting is how he talks about cybersecurity being treated as guilty until proven innocent by the market. Investors are assuming AI is a headwind before seeing evidence. Dan is basically saying that narrative is lazy and premature. He believes cybersecurity is at an inflection point that is not priced in at all. And honestly, this is where his bullishness starts to border on contrarian. He is not just saying cyber will be fine. He is saying it will be one of the biggest growth stories in tech. The host pushes back, and I think this pushback is fair. She questions how you can have conviction when we do not fully understand how AI tools will reshape industries yet. That is a very real concern. We are still early. Some things will be disrupted in ways we cannot model cleanly. Dan's response is to get more granular and talk about IT budgets. This part is critical. Traditionally, cybersecurity made up maybe 5 to 8% of IT spending. Dan argues that number is no longer relevant. Now that AI is embedded across platforms, cybersecurity is becoming foundational rather than optional. He claims that as much as 20 to 25% of potential IT budgets could now be tied to security. That is a massive shift if it proves true. He also mentions companies like Scalar in the same breath, reinforcing the idea that this is a sector-wide repricing opportunity. His big point is that AI is being misinterpreted as a threat when it is actually a long-term tailwind that could reshape cybersecurity for years. He even adds that AI will likely be a major catalyst for mergers and acquisitions as companies race to build end-to-end platforms. Then the conversation zeroes in on Palo Alto specifically. Dan has famously called it a table-pounding stock before, and the host challenges him on whether he still feels that way, especially given the stock's history of earnings volatility. Dan does not hesitate at all. He actually escalates his conviction and calls it a double table pounder. He gives 3 main reasons. First, he believes the CyberArk deal fundamentally changes Palo Alto's trajectory. He credits CEO Nikesh Arora for making a bold move that could unlock enormous long-term market cap expansion. Dan throws out big numbers here, suggesting that a $25 billion deal could ultimately lead to hundreds of billions in market value over time. That is aggressive, but it shows how transformational he believes the platform strategy is. Second, he argues that Palo Alto and CrowdStrike are both at an inflection point where AI starts to materially influence deal flow. He estimates that 25% of deals could eventually be positively impacted by AI. According to him, none of this is reflected in current analyst models or sentiment, which he describes as super negative. That negativity is exactly why he sees opportunity. At this point, the tone of the interview shifts. The host directly challenges Dan's style as an analyst. She suggests that he tends to defend his calls aggressively when stocks sell off, rather than stepping back and questioning whether something fundamental has changed. I actually appreciated this moment because it addresses a criticism many people have of high-conviction analysts. Are they objective, or are they emotionally invested? Dan's response is basically that his confidence comes from the work. He emphasizes the sheer volume of checks, conversations, and experience he brings to his analysis. He frames short-term misses or stock declines as noise, not thesis breakers. He says he is willing to defend a name through volatility because of the depth of his research and his 25 years in the industry. My personal take here is mixed. On one hand, deep research absolutely matters, and short-term market reactions are often wrong. On the other hand, there is always a risk of confirmation bias when you are this publicly committed to a narrative. High conviction can be a strength, but it can also blind you to regime changes if you are not careful. Overall, what this interview really highlights is a massive disconnect between market sentiment and fundamental expectations in cybersecurity. Dan Ives is making a very clear bet that AI does not weaken cyber companies but instead supercharges their importance. Whether he ends up being right or early is still an open question. But one thing is clear, he is not hedging his view, he is planting a flag and daring the market to catch up. Now let's talk about the 3 hypergrowth tech stocks to buy now. The first company we are going to break down is Ciena, ticker symbol CIEN. To understand why Ciena matters, you have to zoom out and think about how the modern digital world actually functions. Every cloud application, every streaming platform, every AI model, every enterprise system relies on one fundamental requirement. Data must move quickly, securely, and reliably across massive distances. That movement happens over global networks, and those networks are under more strain today than at any point in history. Ciena operates at the core of this system. The company designs and sells high-performance optical networking equipment that allows telecom providers, hyperscale cloud companies, and large enterprises to transmit enormous volumes of data across fiber networks. This is not a nice-to-have capability, it is mission-critical infrastructure. As data consumption grows, network operators cannot simply stretch old equipment indefinitely. Bandwidth demand increases year after year, video quality improves, AI workloads explode, cloud adoption expands. All of this forces network upgrades, and optical networking is one of the most capital-intensive and technologically complex parts of that upgrade cycle. What gives Ciena a durable advantage is expertise and scale. Optical networking is not a field where dozens of startups can easily compete. It requires deep engineering talent, long customer qualification cycles, and proven reliability in real-world conditions. Customers deploying these systems are moving mission-critical traffic. Failure is not an option. Ciena has spent decades building relationships with major carriers and cloud providers. Once a vendor is approved and integrated into a network, switching is costly and risky. That creates high switching costs and sticky long-term customer relationships. This is one of the core pillars of Ciena's moat. Another important aspect of Ciena's strategy is the shift towards software-driven networking. Historically, networking companies sold hardware and moved on. Ciena increasingly layers software, automation, and network management tools on top of its hardware. This allows customers to optimize performance, reduce operating costs, and scale more efficiently. From an investor perspective, this matters because software carries higher margins and recurring revenue potential. It also strengthens customer lock-in. The more a customer relies on Ciena's software to manage their network, the harder it becomes to switch vendors. Now let's talk about growth drivers. The biggest long-term driver for Ciena is global data traffic growth. This is not speculative. It is measurable and persistent. Cloud services continue to expand. Data center interconnect traffic is growing rapidly. AI training and inference workloads require massive bandwidth between data centers. One of the most important trends here is the rise of AI. Training large AI models requires moving huge datasets between compute clusters. Inference at scale also increases network traffic. This puts pressure on existing infrastructure and accelerates the need for higher capacity optical networks. However, this is where the balanced growth perspective is important. Network spending does not happen evenly every quarter. Telecom operators and cloud providers go through cycles. There are periods of heavy investment followed by digestion phases. We are currently in a digestion phase for some customers, which has weighed on Ciena's near-term revenue growth. This cyclicality is a real risk. Investors need to understand that Ciena's revenue can be lumpy. A few large customers delaying projects can impact quarterly results. That volatility can lead to sharp stock movements, even if the long-term demand story remains intact. That said, Ciena has navigated these cycles before. The company maintains a strong balance sheet, invests consistently in R&D, and focuses on maintaining long-term customer relationships. It also has a healthy backlog which provides some visibility into future demand. Financially, Ciena operates with solid gross margins for a hardware-centric business and has demonstrated operating leverage during periods of stronger demand. The company is not dependent on aggressive financial engineering. Growth is driven by real customer spending. From a valuation standpoint, Ciena often trades at a discount during downturns in network spending. For long-term investors, these periods can present opportunities, provided you are willing to hold through volatility and understand the cyclical nature of the business. The key takeaway with Ciena is this: the world is not using less data, networks are not becoming simpler, if anything, complexity and demand are increasing. Ciena is positioned at the center of that trend, but patience is required. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The second company we are going to analyze is SanDisk, ticker symbol SNDK. SanDisk operates in one of the most misunderstood areas of technology investing, data storage. Storage does not get the same attention as flashy software or consumer hardware, but it is absolutely foundational. Every digital interaction creates data. That data must be stored, accessed, protected, and moved efficiently. SanDisk specializes in flash memory and storage solutions that are used across consumer devices, enterprise systems, cloud infrastructure, and increasingly AI-related workloads. The company's products are embedded deeply into the technology ecosystem, even though most end users never think about them. One of the biggest challenges with memory stocks is cyclicality. The industry has a long history of boom and bust cycles driven by supply and demand imbalances. When too much capacity is built, pricing collapses. When supply tightens, margins expand rapidly. This cyclicality introduces risk, and it is one of the reasons investors often avoid memory companies. However, there are structural changes taking place that may improve long-term dynamics. First, advanced memory manufacturing is becoming significantly more expensive and complex. Capital requirements are enormous. This limits the number of players that can compete at the highest level and discourages reckless capacity expansion over time. Second, SanDisk focuses on higher-value products and solutions rather than pure commodity memory. Branded products, enterprise storage, and specialized applications allow the company to differentiate and capture better margins. Another major tailwind is the growth of AI and cloud computing. AI workloads are extremely data-intensive. Training large models requires storing and processing vast datasets. This drives demand for high-performance, reliable storage solutions. From a financial perspective, SanDisk has been managing through a down cycle by controlling costs, reducing inventory, and preparing for the next upturn. This is where long-term investors need discipline. The stock may look unattractive during downturns, but these periods often lay the groundwork for future recovery. SanDisk's balance sheet and operational discipline matter here. Companies that survive downturns without excessive dilution or debt tend to emerge stronger when conditions improve. The balanced growth view on SanDisk is straightforward. This is not a stock you buy expecting smooth quarterly growth. It is a stock you buy because you believe in long-term data growth, improving industry discipline, and SanDisk's ability to compete in higher-value segments of the market. For investors willing to accept volatility, SanDisk offers exposure to one of the most fundamental trends in technology, the relentless growth of data. The third and final company we are going to break down is ServiceNow, ticker symbol NOW. ServiceNow operates in a very different corner of the technology ecosystem compared to Ciena and SanDisk, but it is just as essential. If Ciena moves data and SanDisk stores data, ServiceNow helps organizations actually do something productive with that data by streamlining how work gets done across the enterprise. At its core, ServiceNow is a cloud-based enterprise workflow platform. It helps large organizations automate processes, manage operations, and improve efficiency across IT, human resources, customer service, security operations, and increasingly many other departments. The key idea behind ServiceNow is simple but powerful. Instead of fragmented systems and manual workflows, companies can centralize and automate how work flows across the organization. What makes ServiceNow such a compelling long-term business is how deeply embedded it becomes once adopted. Large enterprises do not lightly replace core workflow systems. These platforms become woven into daily operations, decision-making, and compliance processes. Once ServiceNow is implemented, switching costs are extremely high. That creates long-lasting customer relationships and recurring revenue streams. Another important factor is ServiceNow's expansion strategy. The company started with IT service management, but it did not stop there. Over time, ServiceNow expanded into HR workflows, customer service management, creator workflows, and industry-specific solutions. Each expansion increases the total addressable market and strengthens the platform's value proposition. Instead of being a single-purpose tool, ServiceNow positions itself as a system of action. It connects people, processes, and data across the enterprise. That positioning matters because it allows ServiceNow to grow wallet share within existing customers rather than relying solely on new customer acquisition. AI is becoming a major growth driver for ServiceNow, but in a very practical way. Rather than selling AI as a buzzword, ServiceNow integrates automation, machine learning, and generative AI into workflows to help customers resolve issues faster, reduce manual work, and improve productivity. These are tangible benefits that executives can measure. For example, AI-driven incident resolution can reduce downtime. Automated HR workflows can speed up onboarding. Predictive analytics can help organizations identify problems before they escalate. These use cases directly tie AI to cost savings and operational efficiency, which makes it easier for ServiceNow to justify continued spending even in tighter budget environments. From a financial standpoint, ServiceNow stands out for its consistency and quality. The company generates the majority of its revenue from subscriptions, which creates predictable recurring cash flows. Renewal rates are high, reflecting customer satisfaction and platform stickiness. ServiceNow also produces strong free cash flow, which gives it flexibility to reinvest in product development while maintaining financial discipline. Over time, the company has demonstrated operating leverage, with margins improving as revenue scales. However, a balanced growth perspective requires acknowledging the risks. One of the biggest risks with ServiceNow is valuation. High-quality enterprise software companies often trade at premium multiples and expectations are high. When expectations are high, even small disappointments can lead to sharp stock pullbacks. Another risk is competition for enterprise budgets. While ServiceNow has a strong competitive position, large organizations have many vendors competing for attention and spending. Continued success depends on ServiceNow's ability to innovate, deliver clear ROI, and maintain its platform leadership. There is also execution risk. As ServiceNow expands into new areas, it must ensure that new products integrate seamlessly with the core platform and deliver real value. Platform complexity can be both a strength and a challenge. That said, when you step back and look at the long-term trajectory, ServiceNow remains one of the most compelling enterprise software platforms in the market. It benefits from secular trends toward digital transformation, automation, and AI-driven efficiency. These trends are not short-lived. Now that we have broken down all three companies, it is worth stepping back and comparing them from a long-term perspective. Ciena, SanDisk, and ServiceNow operate at different layers of the technology stack, but they are connected by the same underlying forces. Data creation is growing. Data movement is accelerating. Enterprises are under pressure to operate more efficiently and securely. Ciena enables the physical movement of data across global networks. Its growth is tied to bandwidth demand, network upgrades, and infrastructure investment cycles. The opportunity is large, but patience is required due to cyclicality. SanDisk provides the storage that makes digital activity possible. Its growth is driven by data creation, cloud computing, and AI workloads. The risk lies in industry cycles, but structural improvements and higher value products improve the long-term outlook. ServiceNow sits at the application and workflow layer. It helps organizations manage complexity, automate processes, and unlock productivity gains. Its strength lies in recurring revenue, high switching costs, and platform expansion. Each of these businesses has a moat, but the nature of those moats differs. Ciena's moat is technical expertise and customer integration. SanDisk's moat is manufacturing scale, brand, and product mix. ServiceNow's moat is software stickiness and workflow dominance. From a portfolio perspective, these companies also offer diversification across different types of tech exposure. Infrastructure, hardware, storage, and enterprise software all respond differently to economic cycles. That diversification can be valuable for long-term investors. Of course, none of these stocks are without risk. Market conditions can change, spending cycles can shift, competition can intensify. That is why a balanced growth approach matters. The goal is not to chase short-term momentum, but to identify high-quality businesses with long runways and the ability to adapt. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to ask you a question. When you compare Ciena, SanDisk, and ServiceNow over the next 10 years, which business do you think has the strongest long-term competitive advantage and why? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.